Morning, everybody. Let's get going. So this week's guest is Blake Hutchins of Troy Income and Growth, who we talked to the fund about 11 months ago. And I'll be running through the news as usual beforehand. So I want to have a quick look at some Indian funds first, and then Greencoat Renewables, which is looking for more money. And then a brief mention of Rockwood Realisation, which used to be Gresham House Strategic. Starting off with India first. So Aberdeen, New India is struggling with its discount, let's say, but it's not alone in this. This is a long-term chart. It goes back 10 years. And as you can see, actually in absolute terms, the returns are pretty good over the long term, but it has got a discount problem that's been really persistent all the way through. And if anything, it looks though the discount's on a widening trend there. If we compare that to India Capital Growth, again, pretty reasonable capital performance, but its discount has been on a generally narrowing trend apart from the last couple of weeks, and I think that's something to do with Russia, as we'll just talk about in a minute. Here's the table of all the sort of four Indian funds. The one that sort of sticks out there is Ashoka, because that has actually been doing particularly well, and markets seem to be sitting that at the moment. The long-term numbers, India Capital Growth is the best performing there in price terms, and second best in NAV terms to Aberdeen New India. But shorter-term numbers don't look quite so clever for the whole of this peer group. And that's really, well, apart from maybe Ashoka, because sentiment's turned against India. India Capital Growth is down to 100 million now. It has been smaller than that, to be fair. And capital performance has got it back to 100 million again. I wouldn't like to see it shrink much more than that, but you can see what the discounts are now. So Aberdeen New India has come up with a plan to introduce five-yearly conditional tender offers. And those will only happen if it doesn't manage to beat the MSCI India. One of the sort of wrinkles in that is that that's the NAV adjusted for capital gains tax, because this is something that's been introduced in the past few years in India. All investors have big capital gains, and there's a different rate. There's short-term gains or long-term gains, and the funds are subject to this. That makes it quite hard to underperform an index that isn't subject to that. I did some digging there. It looks to me as though ETFs are affected too, so that you can't get rid of by buying an ETF. So just bear that in mind when you look at performance and these funds going forward. So if shareholders agree to this idea, then the first 5-year measurement period runs until March 2027. And if it underperforms, then they'll get offered a 25% tender and 2% discount. The quid pro quo for introducing this is to get rid of annual continuation votes and put a 5-yearly one instead. So there'll be a continuation vote this year, and assuming that passes, the next one won't be until 2027. And these proposals need to be voted at an AGM that's going to be held in September. So that's the idea. I'm a bit dubious, though, as to whether these sort of things really work. Will investors hang around for 5 years worth of underperformance with the hope of getting 25% of their money out? I wouldn't have thought so. So generally, I think people, if it's starting to underperform and underperform that badly over a long period, then people get a bit antsy beforehand and probably have to do something else. And we know, obviously, what happened to Jupiter Emerging. So it tried going from annual redemption offers to 3-yearly ones and ended up being liquidated, or that seems to be heading in that direction. India Capital Growth, it's gone through various iterations of trying to control its discount. It now does 2-yearly redemption offers at a 6% discount, although the next one's actually going to be at 3%. And the one that they just did, they redeemed 13.9% of the fund. So that's not a bad number in the right scheme of things. It's also buying back shares. So it is shrinking, but it's still kind of viable around that kind of £100 million mark. And something like this might have worked a bit better for Aberdeen New India, but we'll see. Just thinking about India generally, 2021 was a great year for the Indian market, and the difference between the performance of the Indian market and the Chinese one was really quite marked, and you can see that showing up there in the numbers, where the MSCI actually went down by 1.5% in 2021. That underperformance of MSCI has actually just seems to have soured sentiment towards emerging markets generally, and that's been compounded by what's going on in Ukraine. And I just think that emerging markets seem to be out of favour at the moment, and that is affecting all sorts of funds. We've always seen some disappear. As far as India goes, with the war and the rising price of oil, it does have an impact on it. One of the things that I suppose that we're not entirely happy with is that India is actually turning to Russia to get its oil, and it's actually increased the amount it imports over the past few weeks. But yeah, I mean, that's just a matter of conscience whether you think that's a bad enough thing to avoid India completely. Looking outside of that, there could be an impact on the current account. So at the moment, there's a current account surplus, but if they have to pay more for the oil, then they could switch into a deficit, and that might affect the strength of the rupee. There is going to be an issue that the agricultural sector may actually be more profitable, but it is going to have to pay more fertilizer, and that whatever way that you cut that is going to feed through into inflation. So those are the sort of negatives. But actually, if you read some of the statements that have come out on India recently, and maybe India capital growth is not a bad one to look at in terms of the results that it published this week, the general message seems to be quite upbeat. So the real things that disturb the whole market, things like the goods and services tax and the demonetisation, they are getting to be behind it now. So the effects of those are now, the positive effects of those are now kind of flowing through. And generally, the economy was in a good shape getting into this. They were also investing an awful lot in infrastructure, which is much needed. And it's one of the things that we highlighted the other day as being a reason why China is so much further ahead than India is in terms of GDP per capita. So it's on the right track. There also seems to be a lot more domestic interest in the equity market, helped by some IPOs last year. So these things do seem to be positive. If you want to go back and listen to David Cornell talking about the fund, he actually talked to Jana on the 26th of November. So that recording is on our website. Greencoat Renewables, they've just announced that they're going to raise some money, and probably quite a lot of money, I would think. So the price is, as usual, is a premium to the NAV and a discount to the prevailing share price. It's not an issue, it's a placing of shares, it's not really an issue that's open to retail investors, and you've heard me say this many times, that I just think that's wrong. And at some point, retail investors are going to be angry enough about this to moan to politicians, I would have thought. But anyway, I think that they won't have any trouble raising money. It does seem to be able to deploy it pretty well. And they've got an awful lot of things that they want to invest in. So they've got a pipeline lined up there, as I say, 600 million euros, 380 megawatts. They're going more and more into other markets outside of Ireland. So Sweden, France, Spain, and another Northern European country, which, given it's a wind farm, might be Norway, might be Denmark. And they've also got existing commitments to things that they're funding that are under construction. So at the moment, the debt on the balance sheet, this is a loan to value. This is not a gearing ratio. This is a loan to value of 43%, and they can go up to 60. I don't think they want to do that as a rule. So I would think they're probably going to try and raise almost all of this, a maximum amount they can raise here. So 251 million shares at €1.12, and then deploy that quite quickly. And this is what the portfolio looks like at the moment. So with some of the opportunities as well. So there are some markets in here that they aren't in yet. So Belgium, Germany, Denmark, and Netherlands, for instance. But they are there in reasonable size in other markets. In Spain, that is a solar asset that they've got that's under construction. But the nucleus of the fund, the core of the fund, is in Ireland, where they're actually the largest operator of wind farms with 16% market share. And that market alone is supposed to sort of more or less double by the time you get to 2030. So there is a huge amount of potential investment, and this is kind of what we were talking about with Traeger the other day. So there's an awful lot that they can invest in, and I would think this thing is just going to keep growing and growing. They've said that higher power prices could add 2 or 3 cents to the NAV this time round. There's also an awful lot of inflation linkage in its portfolio. So I think over 80%. That tails off because it's all linked to the subsidies. The subsidies tail off from around 2029 onwards. And if you want to go on the website, they've got a chart that explains that. And then the revenues will be much more linked to merchant power prices. Obviously, that's all factored into the NAV. It is, I think, remarkable that it managed to cover its dividend 1.2 times last year, despite the fact that the wind generation was actually 16% under budget. That's not uncommon. There just wasn't an awful lot of wind around last year. And I think we were looking at Jolin this morning, and then that was down even more than that. But nevertheless, it did still manage to generate the cash to cover the dividend. And I think that just shows the resilience of the whole thing. There's an awful lot of money being sucked out of the market for these funds. Literally today, Trig said it just raised, or yesterday, raised £277 million. SDCR announced today it raised £100 million. There's an announcement today from Aquila European Renewables that it's made another investment, and now that seems to have absorbed most of the money it had. So I'd imagine that it will be back in full money quite soon. So this whole sector continues to expand, and it needs to if we're going to kind of meet the energy needs that we've got in terms of addressing climate change. And finally, for me, just a quick thing on Rockwood. So as we know, Gresham Strategic, there was an awful lot of back and forth, and we've talked about this a lot on the show. With Harwood now as the manager, Gresham has sort of given up, and it's sold its stake in the company, which was sort of big enough to block most things. And that's been placed with some institutions, but Harwood bought some, and Richard Staveley, who's the guy that used to work at Gresham and then went across to Harwood, bought some more. So he's got 1%, Harwood got 28.9%. So with that sort of backing between them, Harwood's now gone back to the board and said, you know, this realisation idea, we don't think that's actually a good idea anymore. We want to do something different. So the board is thinking about what to do next, and what said is that there'll be an announcement fairly soon. One of the things that I do feel quite strongly, though, is having been all this back and forth, is that some shareholders would have just said, oh, well, okay, I'll undertake the exit route, please. I think they should still be able to if they want to. So whatever happens, there should be an opportunity for people to have a cash exit if they want to. But I would imagine that Harwood would be running the troops and trying to raise more money for the fund at the same time. So there we go. That's enough from me. We are now going to talk to Blake.